do is I want to teach you a quick assessment, okay? How you dig into a deal, right? And so, how do you get started? And then where do you go from there? So what we do in our quick assessment, it's kind of like an equation, okay? See, there's a lot of different ways to look at these deals, lots of different angles to them. A lot of different things that go into this process. I'm just trying to give you a high-level picture of things because that's where you have to start. I want you to be able to have a deal come across your desk, spend 15 minutes on it, and if there's no way it's going to work, throw it off your desk so you can hone in on the ones that have merit. Because I'm going to tell you, you're going to kiss a lot of frogs to find a deal, even still today. I want you to think high level so you can start to look at them and think about them. So we've broken this high-level piece into 5 different factors. First one is a super quick assessment, okay? Then we're going to accurately calculate the net operating income. Obviously, that's important, okay? And you're going to see how we do this. It's going to surprise you a little bit, but it's a really good way that we suggest you do this first. That comes into play with normalizing the expenses as well, okay? Then we're going to consider the number of doors, right? We're going to evaluate the condition of the property, and then we're going to apply any macroeconomic considerations if they're relevant, okay? And those 5 factors are going to give you a window. Think of this kind of like a scatter plot kind of a thing of where your value should be. Now, you're eventually going to have to pick a number and go with it. So example may be, let's say you've got a window for this property of 10 to 12 million, the seller's asking 11, that could work, right? But the goal is to have this come across your desk and literally maybe even as fast as 5 or 10 minutes, you give a rough answer. Super quick assessment. Now the super quick assessment has its own procedures. First question to ask yourself is this property or deal in my target market? Duh. We talked about that a little yesterday. That ideally the target market is one of those 4 markets that I suggested. Your backyard, where you live, or an area that you grew up and know very well. For me, it's Denver, or maybe an area you have a partner or boots on the ground. That's, another advantage of the Warrior program or a group like it. We've got people literally all over the country. Or somewhere you'd like to visit or might even want to retire, okay? Those are the 4 areas, right? And that's where I suggest you go first. Super important. And then, because you're going to have a sense of how the market works and what the drivers in that market are. You're going to know the neighborhoods. And these kinds of things are important. And, if you don't understand all that right away, you're going to have to get out there and learn it and study it and talk to people, brokers and property management companies, and just learn what the different submarkets in a city are. It's because, you need to know where in that city you want to buy, not just the city you want to buy in, right? And, so, you pick that market or markets and you really get good at that market. You look at deals that are in that market. You're not scattered all over the country. It's really hard pressed to know something really well if you're all over. So find one good market now. Remember, I gave you those websites yesterday to start evaluating market. And what are 3 things that we want to see growing? Income, population, and jobs. And what's the most important? I told you jobs, and I'm going to really highlight that for you when I show you the deal presentation, sample deal package. Now, again, if it's your backyard and your backyard only has 30, 40, 50,000 people in it, could be a problem. You may want to be challenging. You may want to go somewhere else. You're going to have to go outside that market, and that's okay. If you live in Manhattan or LA, you may also want to go outside that market. You may not, but likely you will. But you find one good market, you know it really well, and then your economies of scale or knowledge are going to begin to add up, okay? Like in San Antonio, we've got 2 assets a mile away from each other, a 296 unit and the 200 unit. I'm going to show you this afternoon the sample deal that we did when we raised 12 million for that deal, and it's really going to help you. But you're going to, and as you get a beachhead in one of these markets, you're going to get all those economies of scale and knowledge, and you're going to be known there. And so, you're going to be looking at deals, you're going to be making connection with brokers, you're going to understand the flow of the deals in that market, you're going to understand the pricing. So make sure the property's in your target market. Now, I don't know if you've decided on a target market yet. It's okay, you don't have to yet, but get working on that. Make sure you do. Second thing, does the property as presented to you meet the 50% expense rule? Is it roughly in line with the expenses? If it shows 30% expenses, somebody's BSing somebody. You got a problem. Even a brand new property is not going to be that low, realistically. And if they're not in line, if the expenses are not in line, that's a red flag, okay? You know, and candidly, if they're 70%, it could be a clue that there's a hell of an opportunity, okay? So the third thing is kind of the adjustments that are needed on the income statement, okay? You need to make the expense ratio where it should be, realistically, and that goes back to normalizing income and expenses. So when you get that P&L, you've got to normalize the income and expenses. That's what you do. And the MFA Deal Evaluator software helps you do that, okay? Okay. Now, by the way, the cap rate is not the be-all, end-all. It's not the final answer, but it is a point, okay? It is a data point that you want to consider, okay? You figure out what the current cap rate is based on the price that the seller is wanting, okay? You've got to back into that. You know, and then you look at what have competitive properties in this market been traded for on a cap rate basis, right? Super important. You know, is what they're asking realistic? If they're asking for a 2 cap and everything else is at a 5 cap, is that a problem? It could be a red flag, yes? Now, these are the things you want to ask yourself. I know some of this is common sense, but, you know, if I take my income and I take out 50% expense ratio and I divide that by my cap rate, you know, what's the value that I just calculated? Does it come within any sort of range of that offer price that I want to get, that they're asking, right? If not, what's going on here? You know, why are we doing this, right? Now, it may not be super close, but this is the first data point. So take that value and make a note of it. Now, the goal is to get this first step done super quick assessment. So I take my expenses, I take my income, I calculate my cap rate. What kind of value do I have? So that's step 1, okay? Now let's move on to step 2. Step 2 is actually digging into the NOI. So we're going to take a quick break from this incredible episode for a word from our sponsor, my incredible freaking Warrior program. If you haven't heard, I've got this amazing mentorship program. My students are called my Warriors, and at last count, they own somewhere between 190 and 200,000 units that we know of. It's an extraordinary group of people that are just flat out crushing it in multifamily. If you'd like to apply to our amazing Warrior program, text the word CRUSH to 72345 and we'll set up a call. You can look us over, we'll look you over, and I can promise you, even if you don't join the program and it's not a fit, you're going to leave that call better than when you got on it. So again, text the word CRUSH to 72345 and you and I will speak soon. All right, let's get back to it. Now this gets a little more nuanced, okay? You're going to take, now listen carefully, you're going to take the gross income and you're going to use the broker number for the trailing 3 months. It's called the T3. Now you're going to get a T12 most likely, which is the trailing 12 months of financials. But and that's the previous 12 months of financial activity for the property, the income and expenses. That's what you'll get from the broker or the seller. But you're not going to use all 12 months in this calculation. Okay, listen very carefully now. You're not going to use all 12 months in this calculation. Why? Because let's say the property was 99% occupied a year ago, and today it's at 92%. You need to know. You want to make sure you have a value based on the current income numbers, especially in today's market with the collection challenges assets are having, especially C-class assets are having collection issues right now. I told you about my 296 unit asset in San Antonio. We had to pause distributions because of collection issues and high insurance and taxes going up, insurance going up, cost of materials going up, payroll going up. So we had to pause our distributions for a few months. It's no fun. Investors don't love it, but it is what it is. Okay, so I want to look at the trailing 3 months, not the trailing 12 months, so that I have an accurate picture of what's going on today. Does that make sense? So you're going to see financials that look better a year ago than they do today. So you got to take that into consideration. Super important. And the flip side is maybe they bought a property, say 2 or 3 years ago, and they're going through a renovation trying to get it from a C- to maybe a B- stabilized asset. Maybe they bought it at 70% occupied and they're getting it up to 90%. And they're going to be looking for you to value it more based on recent performance rather than historical performance. You know, let's say they want to get that revenue up. So you've got to make sure you've got the most recent applicable information. Again, this is just one data point. Now, we're not going to ignore the other 9 months, but right now for this data point, we're going to focus on the trailing 3 months, okay? So you're going to take the trailing 3 months, now listen carefully. You're going to take that T3 or the trailing 3 months and you're going to annualize it, okay? You're going to pretend you're going to basically multiply that times 4, okay? So you're going to take the trailing 3 months, You're going to annualize it, and you're going to multiply it times 4. You're going to add in any other income. That could include, parking rent, admin fees, application fees, late fees. We talked about this yesterday, and laundry, we talked about all that. So, and what that does is it gives you your gross potential rent. That's the number you should have on the top line. Remember, I showed you this when we normalized expenses yesterday. Then you take out your operating expenses. Now, you can do this on a flat rate basis, okay? You could use, for example, $4,500 to $5,000 a door for operating expenses. Now, you can ask your property management company what that number should be based on their experience in that market. And you can make minor adjustments to that number as needed. But one caveat to that $4,500 to $5,000 a door is, again, a good property manager is going to be able to tell you what that average expense per door is in total. And see, if you have this, you can do a really quick calculation. I hope you guys are getting this, okay? You can do your numbers very quick. You could also get this information from an appraiser, but I really like property management companies for this. Now, you should know, candidly, if you're focused on one market, which I'm telling you to do, what total cost per door is in that market. I'm going to tell you the average across the country is in the $4,500 to $5,000 a door range. B and C properties for the most part for that, okay? But this is, if you know that, it's so easy to do a quick check on a property. Now, if you're looking at, say, a C property in, let's say, North Nashville, right? You got to get to know that area, get to know your average cost per door. And that's really what you want to do. Okay, so as I said, you take the trailing 3 months, you subtract out that market's average operating expenses, find out what the NOI is, then you take that number and divide it by the cap rate. Of course, you've annualized it as well, like I told you, and you divide it by the cap rate, and you get a value spot for a value calculation. So we've got one, now we've got 2 different values, and that's step 2. Now, I know we're kind of making baby steps here, but those are 2 values for your evaluation. Okay, so step 3 is value creation. So you take the existing numbers and you take an average cost per door and you give it a value. So what I mean by this is number 3 is to look at the number of doors, okay? And ask ourselves a few questions. Does the number of doors contribute to our ability to scale, okay? It could be 10 doors because we're already at 10 and this is going to, excuse me, it's going to double our doors. One second. Okay. So again, does the number of doors in this asset we're looking at contribute to our ability to scale in that market? Now, it could be 200 doors and you want to have a full-time staff. Does it make sense to scale? Maybe you've already got 200 doors and your investment criteria is nothing less than 100, but you find a 50 unit and you've already got units there. Lots of upside, great market, great opportunity. It may make sense to buy a smaller unit, right? Does it make sense to do a 50 unit in our business model? Even let's say, your investment criteria is you don't want to do anything less than 40 or 50 doors, but you find a good 10 unit that's near a 50 unit you've got, it may make sense to do it because, the manager can manage both very possibly. So this is a really important analysis that you think through with your team to see if it makes sense to take on whatever size unit, asset you're looking at. Now, here's another one. If you have the capital, can you make the deal happen? Maybe you bring in an outside partner, and maybe a large deal in a market where you've only got a couple of small deals is a great way to contribute to your ability to scale. Okay, let's say you've got 3 or 4 properties in an existing market, and you get another one. I'll give you an example. You've done 3 or 4 deals, say a 30 unit, a 40 unit, and a 50 unit, and then you like I say, you find that 10 unit, and you're thinking, oh God, that's kind of small. I wish it was 20, 30, 40, 50 units, but it's 10 units. It's got a great opportunity. It's in my market. I've already got people working there. I've got a good feel for it. Maybe it makes sense, right? But maybe doing a 10 unit in a brand new market where I've got to learn everything all over again and build new relationships might not make sense, okay? But in the other case, it maybe does make sense. I can add it to my existing portfolio. So again, that's the thought process, guys. And a lot of people don't go through that process and they must, okay? Now remember, this is not your detailed analysis. This is just your first flush to get crap off your desk, right? So you can focus on the ones that have merit. Again, I want you to focus on one market. Do you have a relationship with a property manager? Okay, here's a huge question. Can your property manager handle more? They'll tell you they can, but you really need to assess that. Also, if you're in smaller deals, can they service a larger deal? Or do you need to find a different property management company to handle it? Chances are you do. Remember, I told you that. Management companies that are used to small deals will fail on a big one, and vice versa, okay? Maybe they handle 10-unit properties and you're going to go to a 50. It's not their wheelhouse because they have on-site staff and it's just a different animal, okay? This is very important. But make sure, ideally, that your relationship with your property manager, they can scale with you. So the fourth question to answer is, are there any cost savings or efficiencies to be gained? And it kind of goes back to the first question. Do the number of doors contribute to your ability to scale? Are there any cost savings that you can benefit from? Like I can tell you, in the two units we've got in San Antonio, they're splitting an assistant manager. It's fantastic. It's working great. Saves us a payroll. Okay. So let's say you've got a 30 unit and you want to add a 40 unit. I'm just throwing some random numbers out there. That would get you to 100 doors. If they're close enough to each other, you could hire a full-time property manager, just for those properties. Okay. You see, and you begin to get efficiencies of scale like I'm talking about. So you want to look for that, and so these are the factors that come into, whether or not the number of doors makes sense. So it's not we always do 50 doors or we always do 200 doors. Each deal can have a little bit of nuance. You guys get that? So these are some of the things, again, that you've got to think about. So let's take our gross potential revenue minus our operating expenses, and we add or subtract, based on the number of doors. And if we're going into a new market, we're going to add expenses based on having to go into that new market, especially if there's travel and things like that. In an existing market, you could have some economies of scale. Cost savings, maybe you can subtract some expenses, but if it's a new market, you're probably gonna have to add some expenses, if that makes sense. And that helps me, it can go either way. And then you'll get to an NOI number based on that assessment. You divide that by your cap rate that you've been using since step one, and that gets you your third point of reference, okay? Third value point. Okay, so now step 4, okay? And that is potential value creation. Now, of course, this ties into the condition of the property, right? This is really important. What's the property's condition? What are some required capital expenses from your evaluation? Okay, what kind of shape's it in? The 5 questions you absolutely always going to answer here. What's the age of the property? Obviously, the older the property, the more work you're going to need to do. And I'm going to tell you, this is important for you to know, there's a few types of ages with known issues that come into play. For example, properties built in the 60s and 70s have aluminum wiring. Aluminum wiring is a major issue because it gets brittle and it arcs at the end of the plug. Now, you can put what's called pigtails on it, but if they haven't put pigtails on it, it can cause a fire and burn a building down. Okay, insurance companies really don't like that. Okay, so you need to know that, right? You have to be cognizant. Now, properties also have different kinds of plumbing. There's 4 or 5 different kinds of plumbing these days. Now, pretty much everybody, for the most part, uses PVC or an equivalent. Up north, they still use copper. So, but I'm going to tell you, in the older properties, plumbing breaks and it cracks and it's brittle. So property age is a big deal. And even the sewer lines, what's that asset look like? Are there a lot of big trees? You better scope the sewer lines and see if there's breaks and stuff like that. It's not uncommon at all. And that's what you do as part of your due diligence. You look at the roofs, right? You look at the HVAC units. Now, if you're local, you can go drive there, take a quick look. Have the air conditioning units been taken care of? Maybe the roofs are in good shape. Exterior looks pretty good. I'm feeling pretty good. Maybe I can lower my cap rate a little bit and bump my value, or vice versa. I can't visit it maybe, so I really don't know. Maybe I should be a little more conservative initially till I can go see it. See, that's what you're thinking about here. Now you can hop on a plane and be there in the next day or two. This is why you're not going cross country, guys, okay? If you live on the West Coast, don't go to the East Coast or vice versa. There's plenty of low-hanging fruit closer to you, right? So again, this comes back to speed of implementation, speed of taking action. Super important. Remember, we've talked about how important that is. So, in this market, you've got to make some quick decisions or the deal's going to be gone. If it's a good deal, I can tell you that right now. I told you about that deal we did in Augusta, 24-hour turnaround from getting the information to let's do the deal. So these are the things like that pop up in this business. Then you want to ask yourself, have there been any recent renovations, right? Big question. If you haven't replaced HVA units in 30 years, you're gonna have to factor that in. Like that asset, the one I'm gonna show you this afternoon, we are replacing half of the HVA units. Say, come on, Rod. We're replacing half of the HVAC units, okay? So we raised the money for that. If there's a boiler system or a chiller, it can be very expensive if they haven't had maintenance. We had that come up in our Houston property. And you know, that's honestly a little more difficult to figure out until you've done due diligence. But you want to know what kind of renovations they've done. I promise you the seller will tell you when they put a property up for market what they've done, because they want to, you know, let you know, yeah, we got new roofs, we did this, this, and this. They want you to know, I spent over $1 million in the last year or two on this, this, and this. They'll provide that for you, trust me. But the fourth question is, are all the major systems in working order, right? Super important. This, again, this is what you do in due diligence, okay? And you're gonna have, if there's any question about anything when you're doing your property inspections, the electrical, the plumbing, the sewer lines, the building structure. Remember I told you about that asset, that 296 unit asset that I brought a general contractor to, which I do every single time, and he saw that bulging brick wall that saved us a ton of money, hundreds of thousands, I will tell you. I couldn't give you the exact number because of a non-disclosure, but it was a big number. And so, if it's a stabilized property, chances are everything's okay, but you still got to check on that. A distressed property may have things that aren't working, very possibly. You know, like I said, in Texas, you've got chiller systems. In North, you've got boiler systems. You know, and if you see window units at an apartment complex, that could indicate there's something wrong with the HVAC systems, and it's ugly and it looks terrible. And, you know, we've come across that many times. But you've got to know that going in, right? Does that make sense? So, and you got to fix it if you want to raise the value of that property. Now, last thing I want to mention to you, can your renovation costs be repaid in 36 months? Here's what I mean by this. If you're going to spend $3,600 on CapEx per unit, can you raise the rent $100? That's a 36-month payback. You know, if I got $100 a month for 36 months, that's $3,600, and you paid back what you've expensed. What you've done in renovations. It's a 3-year payback. I will tell you that's my average target. You know, I'd like to be plus or minus that 36-month range. Now we've done deals 40, 48 months, but you can over renovate a property. Very common mistake, okay? And so this is a good back of the napkin check to see if you're spending too much money. And you heard, I think, Jennifer talk about how she found that they weren't getting the rent bumps they needed, and we're doing this actually on 2 of our assets as well. We're keeping them classic units, meaning the way we found them, okay? Because we're not getting the rent bumps when we fix them up. So why put the money in, right? You know, or if you're getting the rent bumps on your classic units that you're getting on the renovated units, why renovate, right? There's no point in spending the money. So these are all the things that you look at, right? Now, we've done deals where it's as low as 24 months. That, you know, the painting the parking lot, it was immediate infinite return because we didn't even pay for it. The towing company paid to put the numbers in the parking spaces and give people reserve park. Oh, I'm sorry, there was a small cost. We had to put reserve signs in. Oh, no, we didn't. We painted reserved and we had the maintenance guys do it. So it really wasn't much of an increased cost. So there was no payback on that. But obviously the lower the number, the better. It doesn't get any better than that painting the parking space example. But 36 is a good range, okay? So you got to take these questions into consideration, right? So you take that gross potential revenue, you take out your expenses, and then you adjust based on the property condition. If the property is in great shape, you make an adjustment down. If it needs a ton of work, it's got to go up, right? Because it's going to lower your net income. The value is going to be lower. Then you take your NOI, divide it to get your fourth point of reference here. You with me? Okay. Step 5. Now, what is that local market condition? What are the economics of that local market condition? And how does it affect the property? This is why you need to know that market or have people there that know that market. What's going on there? Are there businesses moving out? Or remember, we don't want any one-horse towns, even a military base, okay? Be very careful with that. Now, there's some military bases. There's one near my asset in Beaver Creek, Ohio, a suburb of Dayton, that has a big military base there, but it's tech. It ain't going anywhere, okay? But again, you don't want a one-horse town because again, if that horse leaves town, you're in big trouble, okay? What's the population of that market in that local market, right? You need to know that. $10 million or 10 million population, less risky, right, than a 50,000 population. Again, so the size of that economic area can be a big factor. More people, more diversified employment. You're going to see, I'm going to touch on this, not touch on it, I'm going to expand on it actually when I show you that deal this afternoon, okay? More people, more industries, more employment opportunities, etc., right? And so again, usually the more population, the more diversification and much bigger reduction of risk, okay? And vice versa if it's a small population, okay? And remember, I think I mentioned yesterday, and Tyler might talk about this, there are preferred markets. And the preferred markets are where there's a ton of employment, ton of population. Fannie Mae and Freddie Mac has identified these preferred markets where they know the risks are greatly reduced because there's tons of jobs and tons of demographic to rent these units, all right? It's common sense. Smaller population increases your risk. So how does that affect the value of your property? Again, job and population growth, huge factors. Now again, yesterday I gave you websites to research this. Remember, bestplaces.net, city-data.com, datausa.io, census.gov. Those are great places to start playing around with this. And so make sure your population and job growth supports the rent bumps. Now, this is very important, and I'm going to show you this when I show you the sample deal package on that asset in San Antonio. You want to see disparity between the median income, between the, not disparity, you want to make sure that the median income supports where you believe you're going to take the rents, okay? You want to make sure that the people there make 3 times the amount of money that they need to pay in rent to rent one of your units, okay? That's the best way to analyze median income in a submarket. Now, the city may not have that median income, but maybe the submarket right around your asset does, okay? And you've got to look at that. And these websites I gave you will show you that, okay? Because if you're planning to raise your rents $100 or $200, you need justification. So do your research. Look at job growth and look at median income. Again, job growth should be at least 2 or 3% a year. Population growth should be 3 or 4% a year. You want to make sure there's more people coming in than going out. And with this political rift that we've had tons of people leave California and New York. We've had tons of people come into places like Florida and Texas. So, these are things you got to look at. And you want to make sure you have current information as well, because this is changing very rapidly right now. But you want to make sure there's greater demand. So do your homework on that. Now, here's another one. You've got to, and I talked about this yesterday, I won't talk about it again. You've got to look at the surrounding retail. Honestly, retail got hammered by COVID. There's been a lot of changes in retail. You're seeing retailers that are going out of business, but people are stepping in, the market adjusts. You're seeing more big fitness centers. You're seeing different kinds of tenants in some of the retail places, but I want to see major retailers, okay? I want to see Lowe's. I want to see Home Depot. I want to see Starbucks. Because they, big grocery stores like Publix and that do their homework before they go into a market. Even Walmart does extensive homework. Well, honestly, I won't do a deal unless there's a Starbucks within 10 minutes. True story, okay? I should have stock in that company. And again, back to median income. Does a median income support that rent growth? Super important. Now, again, I'll talk about that in much more detail when I show you that sample deal package. But, again, I'm repetition. If a tenant's paying $1,000 a month, or $12,000 a year, I want them to make $36,000, a year. If they're only making $30,000, it may not make sense, guys, okay? So you got to know what your median income is in your submarket. Now, if you know the market, maybe there are people moving into the area with higher incomes and the demographics of that neighborhood could be shifting, okay? That happens very regularly. So that could be a factor as well, okay? If you know there's new industry coming in, there's a factory going in with higher paying jobs. This is why you got to know the market, super important. We have our warriors do area analysis where they present an area to the other warriors even if they don't have a deal, because you got to do this homework. And they talk about businesses going in, going out, and that's something you should do as well. Once you pick a market, you should do a presentation of that market. What's great about it? What's happening with population and income and jobs and employment diversity and so on. You're going to see what I'm talking about here when we get a little later. Okay. But again, you got to know that income there can support your rent bumps, okay, for your value add, right? We're adding value, increasing the rents. So do the rent buy economics work in that area? Does it work in favor of renting, right? Now this is very important. Rent buy economics, okay? So what do I mean by that? Let's say you're paying, just for numbers, let's say you're paying $50,000 a unit for that apartment complex, but there are equivalent homes selling around that thing for $60,000. And someone can move out of that apartment and buy a place to live. That's a problem, okay? You want to see disparity. And I'm going to show you that again when I show you. I keep referencing that sample deal. You don't want to miss that. So you're going to see that I'm going to show you what the homes are selling for around that asset. I'm going to show you what we paid per unit, and you'll see disparity. You've got to see disparity. Super important. And again, I'm going to give you that sample deal package. It'll be in your resources tonight. If you don't love, if you're not a super extrovert, you can just say, if you're ever interested in getting into this business, this is what we look for, and hand them that freaking package. Use mine, I don't care, and say, this is what we look for. If I find something like this, let me know if you want to see it, right? But in those presentations, we want to show that disparity. Now remember, guys, this is a learned skill. You're going to get better with this as you learn over time, and this is high level. To become great at this, you've got to do it many times, okay? And trust me, it's going to be hard the first few times. It's going to take you a few hours, and that's okay. It'll get shorter every single time you do it. But this is to make sure you don't miss anything, okay? And really more than anything else. Everybody started where you are. Every war you've seen on the panel started where you are. So enjoy it. Play with it. You're going to get better and better. So now you've got the 5 steps, the 5 value points. You've got these 5 numbers, and it gives you an idea if you want to dig deeper, right? You've got an idea of, where you're at. And then once you've got these values, you got to ask yourself a few final questions, okay? Is the broker you're working with experienced in multifamily deals? Now, this may not sound important, but it's super important. Do they really know what they're doing? Because I'm going to tell you, as I told you, you're going to see occasionally single-family residential brokers trying to sell some of these smaller multifamily deals, and they literally haven't got a clue about the numbers they're giving you and what's normal. And then you're on the flip side, there's some brokers, this is all they do, and they're really good at it. They know the market. They know what they're doing. They've got integrity. They'll give you good information. So it's important to know when you're looking at these values, have you worked with this broker before? Do you have any sort of rapport built with them? Do you know anything about their character? By the way, you can get references for brokers. Don't be afraid to ask for references, okay? Is the deal on market or off, right? If it's an off-market deal, major factors could come into play. If it's a larger off-market deal, they might be trying to see if they can get a higher price and see if anybody will bite off on it. And that way, when it goes to market, it may actually end up selling for a little bit less than in a quasi-bid process. Then the flip side for smaller deals, a less experienced broker, it may be an off-market deal, but the value really hasn't been established. And, less experienced people could be involved in the process. You might be able to get a better deal. I've seen that many times, okay? Once it goes to market, then everybody's going to find out it's a good deal and the price goes up. So these are all factors you want to ask yourself, right? So taking all of these quick calculations, is it in my values? Is it roughly within my asking price? Are your valuations within, say, 10 to 15% of their asking price? If it's way outside, probably not going to want to pursue that. But you might have a conversation with the broker and can really build rapport and build credibility. Let's say you call them back and you say, I've got a range of 5.2 to 6.3, and you guys are asking 7.5. I don't understand how you got to 7.5. And I want you to know where I'm at. And I'm happy to put an offer in if you think it's worth it. And let them give you some feedback. And you might ask them, how'd you come up with those numbers? And then you say, can I go through these 5 steps? Maybe they're going to ask you how you came up with your numbers. And you say, let me show you what I'm doing here. And if you show them these 5 steps, you're going to blow their socks off, okay? I'm going to tell you. Now, they may disagree with some of your calculations, but I'm going to tell you it'll definitely build credibility when you do that. And they may come back and say, why don't you put in an offer at 6.2? Now remember, guys, this is a high-level review, okay? You're not stopping here. You're going to put this right into the MFA Deal Evaluator software and then fully analyze it, okay? Now again, you're going to look at 200, maybe even 300 deals to find one, but you're going to get better and better as you do that. Okay. All right, guys. So one other quick thing. We encounter so many people that are frankly frustrated. They're looking in the mirror and they're frustrated that they haven't been able to escape the rat race. They haven't been able to build cash flow to the point where they're able to have financial and time freedom with their families. And maybe they see other people buying real estate and creating, incredible cash flow, and they think, well, it's just scary. Buying apartments is intimidating. And I get it. See, that's why we created our Warrior Mentorship Program. They're our coaching students, and they've had extraordinary results. My students, I've been teaching about 5 years, and they own upwards of 140,000 units now that we know of, right? And we feel like it's just getting going. Now, we're looking to grow this group and really take it to the next level. And honestly believe that the greatest transfer of wealth could be upon us right now with this current economic environment. Everything's going on sale. So we're looking for people who want to follow a proven framework, really like a blueprint or a map, literally step by step. And then they're able to leverage our systems and our incredible network to raise money and equity, to find deals and close those deals and build partnerships, really nationwide. So if you're interested in finding out more about how you can become more in our incredible network and take advantage of the unbelievable opportunities that are upon us, you can apply to my Warrior Mentorship Program by texting the word CRUSH to 72345, or you can go to mentorwithrod.com. And what we'll do is we'll set up a call so you can check us out and we can check you out and see if it's a fit. Now again, you can go to mentorwithrod.com or text the word CRUSH to 72345 to apply, and we will speak soon.